This is my crypto investment strategy and how I gain exposure to the most exciting market we'll ever see in our lifetimes. No get-rich-quick schemes or anything like that, just simple steps that you can follow over the long term to grow your portfolio. The first thing we need to do is understand that crypto is a collection of very different assets. Really, the three main areas for me are property, platforms, and currencies. Not all cryptocurrencies are actually currencies. When we go over to the list of cryptos right here, you can see Bitcoin at the top, Ethereum, and then coming down to a bunch of other cryptocurrencies that have very specific use cases. Now, because this is a technology market, most of these cryptos are, of course, technology investments. But there are many cryptos that aren't that. In fact, you can actually invest in gold through cryptocurrency as well, essentially like an ETF where you get exposure to gold. So there's many different types, but we can really group them into three main areas. Property or a commodity like that. I think Bitcoin is the same as investing in property. A property is a long-term investment. You don't look at the price of your property every 5 minutes. Why do you do that with Bitcoin? Bitcoin is a scarce asset and it goes up over time. Over the last 10 years it has. It doesn't go up every day, but over the long term, if you think of Bitcoin as a property and have that mindset, it's going to be a very different investment for you. How about platforms? Well, Bitcoin really is unique in being a unique digital property, a digital asset, a digital commodity. Doesn't matter what you call it, it is what it is, but everything else is different. Everything else is really working on being some sort of platform, a crypto business, crypto infrastructure, something like that. Those are different as well. A platform is something like Ethereum. Ethereum, its tokenomics are controlled mostly by developers and people that vote on those systems. Bitcoin's tokenomics will never change. Ethereum is infrastructure. As you come down, obviously the smaller cryptos may be trying to also do infrastructure. They may be crypto companies. They may be exchanges. Now, an exchange is a business and Bitcoin is not a business. So what I'm really getting at here is how much of your investment as a percentage do you want to put into something like a property, a platform, or a business? The risk profile that each one of those has is very different. And then we can come to something like an actual currency. US dollar Tether, USD coin, and also Terra USD. These are US dollar stable coins. That means essentially they're a crypto version of the US dollar. Do you want to hold the US dollar? Well, you might do, because in crypto, you can actually lend out US dollars. So USDC, USDT, UST, you can actually lend these out to other traders and get anywhere from 5% to 20% as an interest. So you might want to have that as part of your portfolio as well. There's less volatility in that and you get some passive income. So when you can split up all of these sectors and different coins and analyze them, you can then move on to how much you're actually willing to invest in each one as a percentage of your portfolio. I can't really go more in depth than that in this video, but hopefully that shows you just how different each coin can be and the risk exposure that you're getting by investing in each one. If you want to know more about this and actually how to do your own research, then I will link my crypto investor course in the description. There are 150 videos going over each different crypto type, how to do your own research and look at all the different types of crypto, and then putting a crypto portfolio together. So all of this is in the same course and it gets updated over time. I will link that in the description. After you've done all that research though, you have to decide how much of your spare income that you want to put into the crypto market over time. This is going to be different for everyone depending on how much risk you want to take, how much spare cash that you have, what you're saving for, or if you want to split it between crypto versus stocks or anything else. I'm not going to say that investing in stocks is a bad thing. I personally am all focused on crypto because I believe it gives the exact things that everyone needs, which is passive income, yield, risk on, also property type investments. It really is a revolution in finance, and that's why I'm all focused on crypto, but everyone's different. You have to take your income, whatever that may be, whatever that is, and then obviously minus out your costs, your rent or your mortgage, your living costs, all insurance, car costs, everything else. When that has all been minused and you have some extra, This is the money that you have no other use for. That should be going into risk assets. This is the same for crypto or anything else. Now, with crypto, it's different than stocks. Most stocks are risk on, but not all crypto is risk on. Like I said, if you want to buy some gold, well, there's an easy way to do that with a crypto, because there is a crypto called PAXG that actually just charts the price of gold. Now, is gold a risk on asset? I don't think so, but you can use crypto to invest in it if you want. Also with dollars, why have a savings account that yields literally 0% when you can have a US dollar stablecoin that yields 20%? So crypto is making investing literally better for everyone, in my opinion. But the main thing here is do not risk money that you can't afford to say goodbye for at least 5 years or more. When you invest, it has to be through 5 or more years. I'll get to that in a second why, but if you are buying something with the hope of selling it for more money in the short term, you are a speculator and not an investor. Nothing wrong with speculating, but it's not investing, and it requires a completely different mindset that is not an investing mindset. Next, I'll split the money that I have into different sectors dependent on risk, and then just choose how much risk I want to take. Each person's risk profile is different. But really important is that volatility is not equal to risk. Risk is the probability that you will lose all your money permanently. Volatility is simply the extent to which prices move. I do not consider Bitcoin to be any more risky than any individual stock in the market. Facebook, Netflix, these are companies and they can be replaced over time by new competition. Bitcoin is property and it's going to be there forever, pretty much. So is it really more risky than anything else? Now, it's very volatile, and that's just something that you have to put up with over time because it's a new market. But the way that you reduce volatility over the long term is just dollar cost averaging, which I'll get onto in a second. But you can split this up into low risk, like Bitcoin, medium risk, which are the platforms, because platforms can be replaced by a competition and they can change over time. And then high risk, something like NFT speculation or some tiny altcoin that may not be around in a few years. How much do you want to put into each section? You could put 60% here, you could put maybe 20% here, and then 10% here, and then 10% in some stable coins that give you some yield. That just gives you an extra bit of yield and also reduces volatility in the portfolio because they won't be going up or down. Once you've chosen that, then you can turn to the long-term investment strategy that most people use, which is dollar cost averaging. Very simply explained, this is just putting in a small amount of money over the long term, not actively trading, not trying to beat the market, just trying to participate in the growth of the market over the long term and make sure that the average price that the cryptos that you buy, that you get, is not different to the market price. We expect crypto in general to move up in valuation over time as more participants come in and it becomes a working part of the global economy. Why complicate it? All you have to do is just drip feed investments in over time so that during times when the price is high, you're buying some, but during times when prices are low, you're also buying some. There is all of this FOMO that people get when the price rises, that they have to jump in right now because we'll never see this price again. But there's always a downturn for some reason. And that is actually when you should be investing, because that is when the same assets are relatively undervalued in comparison. So what is dollar cost averaging? It's just a long-term strategy. Invest over months or years. Like I said, if you're an investor, you should have a very long-term 5-10 year mindset. That's what investing is. There's no point trying to beat the market. You don't want to beat the market because then you're basically speculating on where you think the market will be. There's nothing wrong with being a speculator. If you want to trade or speculate, it's a completely different strategy than investing. And the most important thing is to invest in a bear market. What do I mean about investing through a bear market? Well, essentially when there is an economic recession, these are typically the best times to actually invest in the best assets. You can see here the NASDAQ. So this is a collection of the best tech stocks in America. Each drawdown, you can see, I've circled them here, has historically been the absolute best time to invest. Now, there's reasons for this. Tech stocks are growing as a part of the economy, but also we value tech stocks and cryptocurrency in dollars, which is a inflating asset. And so the price of hard assets like Bitcoin and other hard cryptos will, all else being equaled, and that they're actually useful, go up over the long term. Buying during the bear market, during drawdowns, has typically been the best time to buy. Once you have that strategy and the percentages that you want to take, that's it. You just do that over the long term. You can see dollar cost averaging is a strategy of potentially investing a certain amount each week and then splitting that up into percentages of the cryptos that you've researched and think that you want to hold. I've got some examples here of Bitcoin, ETH, USDC, and maybe 5 to 7 alts, whatever it is. The percentages will change depending on who you are, how much risk you want to take, but the strategy is just a framework for you to implement over the long term. There's two ways you can dollar cost average over the long term. You can do this manually every week, which is fine, or most crypto apps actually let you do this and pretty much automate it. All you have to do is make sure that your account is topped up with the money that you want to invest. So for example, I use a bunch of different crypto exchanges. I will link these in the description. Some of them have sign up bonuses and offers, but KuCoin, for example, you can go to their trading bots, go to DCA and create bot. You can then set the parameters in any way that you wish to invest every day, every hour, every few weeks. And then you can invest exactly how much you want per time as well. Right here, just put it up as whatever amount of your portfolio, press create. And as long as you have funds in there, it will just DCA and dollar cost average over the long term. Binance have a version as well. You can see here, you can set it up with the same strategy, have an amount of money that you put in at regular intervals over the long term. The important thing really that I want to get across is that I do not try and beat the market. I just try and manage my risk and let the market grow itself, because I'm not cleverer than the market. I just need to manage my risk, make sure I don't blow my portfolio up, and then the growth is going to come. Once you have a portfolio set up, you might want to use passive income techniques to get passive income, but also compound your portfolio and make it bigger over time without taking any extra risk. There's very different ways of doing this. You can use many different platforms, decentralized platforms or centralized platforms to do this. So for example, Celsius Network, they currently pay 5% on Bitcoin. So if you have Bitcoin as part of your portfolio, you can get an extra 5% per year just lending it out on Celsius. You can put your coins in or out at any time. There's no lockups or anything like that. There's also Nexo. They do exactly the same thing. You can put your coins on there. They pay you a few percent for Bitcoin, Ethereum, and stable coins. They do have sign-up offers, so I'll leave them linked in the description if you want to have a look. You don't have to use this, but it does increase the portfolio returns over time. And of course, the larger it gets, those percentages do add up. I don't think anything I've said in this video is financial advice. It's just a structure to get you where you want to go without taking crazy risks, trying to ape into crazy little projects that are going to go to the moon. That era is over. We need to get serious about this and invest over the long term and realize that this is a big growth industry and we don't need to take unnecessary risks to get big portfolios. If you want to know more about how I set up my portfolio, my trade alerts, and my portfolio itself, that's all in the Crypto Investor course. You can also join the private Discord groups through that course or the public Discord group. I'll link that in the description as well. More resources are down in the description. I'm James, it's MoneyZG. Cheers for watching, and I'll see you in the next one.